I'm here to give a short overview of the SKAGEN Kon-Tiki fund in March. Kon-Tiki's performance was flat during the month, whereas its benchmark edged slightly higher during the same period. We added 5 new companies during the month and exited completely from 2 others. At the month end, the portfolio consisted of 108 companies and the cash position was just below 4%. The Kon-Tiki portfolio remains very attractively valued on both an absolute and relative basis and trades at a significant discount to the benchmark. We believe there to be around 40% upside for the top 35 holdings, which together make up over 70% of the fund. Year to date, SKAGEN Kon-Tiki is up nearly 4%, which is slightly less than 3% ahead of the index. Looking even longer term, it has delivered annualized returns of 17% since inception in 2002, which is almost 8% ahead of the benchmark. Looking at the drivers of performance year to date, Hyundai has been the best performer. The Korean car manufacturer, which at 6% is the second largest holding in the fund, has increased shipments this year, including growth in overseas orders. The second best contributor this year has been Great Wall Motor, which is the fund's 4th largest position. During March, it announced that net profit for 2012 had grown 66% on the prior year, and the dividend payout ratio increased to 30%. On the negative side, Vale, the Brazilian iron ore producer, has been the largest detractor so far this year. In March, it announced the suspension of further construction of an Argentinian potash project as costs had almost doubled to $11 billion. Vale has already spent over $2 billion on the project so far, which is 45% complete, but it has been unable to negotiate tax breaks with the Argentine government. Unless the dispute is resolved, it is likely that the government will take over the project. Another top 10 holding, the State Bank of India, continued to detract from the fund's performance during the month and is the second largest loser year to date. Looking at the portfolio composition, 5 new companies entered Kon-Tiki in March, which reflects the many good investment opportunities the team is seeing at present. Firstly, Ranbaxy Laboratories is India's biggest producer of generic drugs. The company has had production problems, however, which have left the shares trading at a steep discount to most pharmaceutical companies. But with underlying growth of around 15%, driven by sales in India and Africa, we believe it merits at least a doubling of the current valuation. Secondly, X5 Retail Group is a Russian grocery retailer, which has returned to the portfolio after we sold it in 2009. The company has gone through difficult times, contributing to a share price fall of more than 60% since its peak, but we believe it has the potential for huge upside if they are able to improve operational performance. The third new entrant is CCU, which has built a leading position in Chile's beverage market with a number of leading brands and a strong distribution network. The company is majority owned by Heineken and Quinenco, who should provide beer and local expertise, and its shares currently trade at a discount to peers. Fourthly, Apollo Tyres is a leading Indian tyre producer. The domestic market is seeing structural growth, with car ownership well below that of China, for example. We acquired the shares after more than a year of research and a visit to its impressive main plant. The valuation is also appealing versus global peers. Finally, we bought Citigroup, the US financial services group with a strong presence in emerging markets. Citigroup has been a successful holding for our SKAGEN Global Fund. Exiting the portfolio during the month were the Brazilian companies Eletrobras and Petrobras, both of which have been long-term holdings in the fund. That's all for this month. Thank you for watching, and for more information, please visit the SKAGEN Kon-Tiki section of the SKAGEN website.